The U.S. Treasury yield curve has provided some interesting signals for investors as it has slowly inverted outward toward the long end of the curve. The 3-year Treasury yield, which is currently the lowest point on the yield curve, first inverted by dropping below the 1-month Treasury yield in early March of this year. Meanwhile, the 10-year Treasury yield, in a lazy mood, took a bit longer but finally dropped below the 1-month Treasury yield recently. Both the 20-year Treasury yield and the 30-year Treasury yield are still above the 1-month Treasury yield. However, we could see the entire long end of the yield curve inverted within the next quarter. The inversion of the yield curve is watched by many investors because it has a good record of preceding recessions. However, the markets seem to be doing a pretty good job at ignoring interest rate action, at least for the moment. At the same time, margin debt has been one of the driving forces that has lifted the U.S. stocks higher. Buyers seem to have so much demand for stocks that they are willing to borrow money to chase stocks higher. So much demand that the margin debt is near all-time records. So is there a conflict in the stock market based on these two indications? Let's take a look. The big questions are, why should the stock market care about an inverted yield curve? And why should stock traders care about bond trading activities? Well, inverted yield curves have been a good forecast for recessions and stock market downturns. Based on history, a rough measure is that it takes about 8 months for the stock market to peak and start moving lower once the treasury yield curve inverts. However, please don't count on the market going up for 8 months and then sell. The stock market always has something else planned for you and your money. So it is quite possible for the stock market to have a downturn sooner or even later than that. Simply because something has happened over and over in the past does not guarantee it will happen again in the future and in the same way. Regardless, an inversion has a pretty good track record of forecasting downturns in the markets. The reason that an inverted yield curve has such a good track record of forecasting market downturns is derived from the investor expectations that factor in a yield curve inversion. When the economic outlook for the future becomes less certain, investors have a tendency to buy longer-term treasuries to protect their capital. Simply, supply and demand says that the increase in demand for long-term treasuries drives the price of those treasuries higher, which in turn results in a lower yield on that treasury. If investors become really nervous, they tend to buy the longer-term treasuries that have lower yields than shorter-term treasuries. The reason is that an investor wants to lock in the yield for a longer period of time, giving up that higher return that would last only a short while, as the investor expects the Federal Reserve to lower short-term rates to offset an economic slowdown of a recession. The S&P 500 has done a pretty good job of ignoring the inversion because investors feel they have more time. And as we have discussed, it appears as though investors may be looking for the markets to climb back to the recent all-time highs in the market. One of the factors that has helped lift the stock market higher has been the willingness of buyers to borrow more money to invest. There is that simple supply and demand equation again. Investors can borrow money to purchase stock, and that is margin debt. We have discussed margin debt many times, but not recently. And as discussed, watching the amount of margin debt can give investors a good perspective of how much demand and confidence investors have in the stock market. Margin debt reached an all-time high of over $668 billion in mid-2018. However, by autumn 2018, margin debt started to decline more rapidly than we have seen in some time. Margin debt continued to decline and then bottomed at about $554 billion in December of 2018. It should be no wonder that this decline in margin debt coincided with the decline in the stock market also in late 2018. And hopefully none of our viewers received a margin call during that time. Since the end of 2018, margin debt has begun to rise. Margin debt has risen from about $568 billion in early 2019, and according to the most recent information from FINRA, it has risen to about $581 billion by February of 2019. But please note that margin debt information from FINRA has a lag time of about at least a month, so we are now only seeing February data. Regardless, the recent rise in margin debt is a sign that investors are viewing the stock market as more reasonably priced. So, the contradiction or the mixed message is that the inverted yield curve is indicating recessionary conditions and a potential market downturn, while investors seem to have more confidence in the stock market, at least enough confidence to borrow more money to buy stocks. Although I am going to keep my eye on a margin debt, I'm going to watch the bond market very closely because the bond market is huge, and that's where the big boys and big girls play. As for my viewers, I hope you subscribe and keep watching this channel. So for today, that's ChewDog Charts. Thank you.